Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before we get started, a few quick reminders. Anyone that is registered for today's program will be receiving a copy by the end of this week. And if you have any questions, feel free to enter them into the Q&A bar in the lower right-hand side of your interface. Now, please join me in welcoming back Erin Kerrigan, founder and managing director of Kerrigan Advisors. Erin, I always look forward to your themed presentation decks. I won't ruin the surprise with this one, so I'm going to let you take it away.
Okay, thank you, Rachel, and thank you, AIADA, for having Kerrigan Advisors lead this webinar about the buy-sell market and blue sky values. Today, we're going to attempt to answer a question on many buyers and sellers' minds. Specifically, are blue sky values peaking? Now, while I do not have a crystal ball that can perfectly reply to this question, throughout this presentation, I'm going to share data that will certainly provide us with an informed perspective so we can each make our own conclusions. Given the time of year, I thought it only appropriate to employ a college football that is, theme to our September discussion. Determining blue sky can be as challenging as predicting the winner or loser of a college football game, as it was last weekend when Notre Dame lost to Marshall at home. Sorry, Irish fans out there, including my son, who is a sophomore, this picture just perfectly elucidated the point that I was trying to make here. So unlike Notre Dame football, the 2022 buy-sell market has gotten off to a very strong start, with 167 transactions completed in the first half of the year, an increase of 16% relative to the first half of last year. On a trailing 12-month basis, we had 406 transactions through June, surpassing 21's 12-month record. Based on Kerrigan Advisors' current activity, we do expect the number of buy sells to remain high through 22 and into 23. Now, looking at this data, it is very clear that our industry continues to consolidate in a meaningful way. And that consolidation is widespread, with every state seeing an uptick in transaction activity, particularly high-growth states with business-friendly practices, such as Texas, Florida, Utah, and Colorado. Colorado, for instance, led the consolidation movement last year with 17% of its dealerships selling, including our client Stevenson Automotive Group, the largest private dealership group in Denver. Now, at this pace, if it was to continue, nearly every Colorado dealership would sell in less than 6 years, leaving the state with just a handful of owners. Now, despite the negative economic headlines and a very volatile stock market, including today, the auto retail industry does remain focused on expansion by acquisition, particularly as profits continue to rise. Through the first half of 22, Kerrigan Advisors estimates the industry earned $4.3 million on a rolling 12-month basis, a 207% increase from pre-pandemic levels. Rising earnings have resulted in nearly a twofold increase in blue sky as compared to the time before COVID. With the industry entering this third year of historically high profits, buyers and sellers are really grappling with how best to value a dealership. While most dealers agree a return to pre-pandemic operating margins is unlikely, few have great clarity about where the quote-unquote new normal will settle out once inventory levels rebound. Projections are particularly challenging given all of the change on the horizon, including electric vehicle sales, agency models, and online sales, as well as, of course, the near-term risk of a recession, and frankly, new entrants like Tesla and Rivian taking market share. Towards the end of this webinar, we will discuss how the market is grappling with this valuation of blue sky and the conundrum it presents. One highly positive factor that continues to drive buy-sell activity and valuation is the tremendous rise in dealer liquidity since 2020. Today, dealership balance sheets are flush with cash, with current assets nearly double current liabilities. a 50% improvement from pre-pandemic levels. And debt to equity likewise is at an all-time low of just 0.72. With these fortress balance sheets, we find most dealers are looking to capitalize on their financial strength and redeploy their profits back to the industry they know and love, resulting in more demand than supply for dealerships on the market today, which is exactly what we found in our 21 dealer survey, where 77% of dealer respondents indicated they plan to add one or more franchises, while just 3% plan to sell. We will soon publish the results of our 22 survey, and they are largely the same. Most dealers are buyers, not sellers. Those seeking to acquire dealerships are highly aware of auto retail's industry-leading return on equity, which skyrocketed to 55% last year. Many auto dealers believe there are few private investments available today that can provide the risk-adjusted returns of an auto dealership. In fact, some dealers who do plan to sell in the near term are holding off right now, realizing they may get a lower blue sky value in the future, as we'll discuss a little later in the webinar, but they're willing to take that risk because they want to continue to reap the benefit and make the kind of money they're making in the industry today. Plus, they're aware that few buyers are willing to pay them a multiple on their record current earnings. Now, while the industry continues to post tremendous profits, there are signs auto retail may be approaching an earnings tipping point, as the impact of record inflation coupled with rising interest rates begins to take an economic toll on the car buying consumer. Notably, in June 22, while inventory levels declined 21% compared to June 21, days supply actually increased that month by 24%, rising above the prior year's level for the first time since the start of the pandemic. Consumers are also increasingly tapping into their savings as well as borrowing more to sustain spending levels. In fact, both of these metrics, consumer borrowing and savings, have deteriorated to 2019 levels, with revolving debt near an all-time high and consumer savings plummeting from over 25% to under 5%. Rising prices and economic concerns have caused consumer sentiment to decline to the lowest level on record since the index initiated in 1952. Historically, the U.S. new vehicle SAR is highly correlated with consumer sentiment, as you can see on this graph. So while today's low SAR is primarily a result of limited supply, the rise in days supply may be an indication of weakening consumer demand and a harbinger of lower new vehicle sales rates even after inventory availability rebounds. Wall Street is certainly reflecting some of these risk factors. Year to date through August, the Kerrigan index of the 7 publicly traded auto retailers was down 17.6%, underperforming the S&P 500 by 3.3%. Now, while the index remains 37% higher than pre-pandemic levels, the valuation declines year to date are notable, particularly given the record second quarter profits posted by the publics. The public's average blue sky multiple on current earnings is now at a 7-year low and just 3.4 times. Valuation multiples do reflect investors' growth expectations for a stock in terms of the earning growth expectations. At the height of the pandemic in 2020, Wall Street correctly expected high earnings growth in subsequent years. In 22, investors are messaging that today's record earnings are potentially unsustainable and are thus expecting lower future earnings when valuing these stocks. As a result, after a groundbreaking 21, U.S. public auto retailers' acquisition spending in the first half of 22 declined by $1 billion, a 49% reduction from the first half of 21. These companies are now tracking to $2 billion in spending, which is less than a quarter of 21's level. Now, because of this, the public saw their share of the buy-sell market decline to just 9% of transactions in the first half of the year, a dramatic reversal from 21 when they were the dominant buyers. Simply put, the public's lower valuation multiples are limiting their pricing power and prompting more stock buybacks. In fact, in the first half, these companies spent more than $2.2 billion on stock buybacks, a 97% increase over the same period of last year, switching effectively the spots in this pie graph where you see the dealership acquisitions represented about 50% of spending in the first half of 21. Now stock buybacks represent about 50% of spending in the first half of 22. It is important for us to remember that for an acquisition to be accretive to a public company's earnings, the multiple they pay must be lower than the multiple at which they trade. At their current multiples, many of the publics are simply priced out of the market. Since these companies are the most well-funded of the major acquirers, changes in their valuation multiples and their buying patterns have a direct impact on the buy-sell market, particularly for large group transactions, which interestingly declined in the first half of 22. We believe at Kerrigan Advisors that this decline is a direct result of the public's reduced spending, as well as the rising interest rate environment in which we find ourselves. This is because larger transactions are more sensitive to fluctuations in the financial markets, as these transactions employ more acquisition financing and debt. Now, with rising interest rates, it is important to remember there is a clear inverse relationship between interest rates and the value of any business. This is best evidenced when looking at a public company's stock price relative to its bond yield. You can see here that as AutoNation's bond yield goes up, historically its stock price has declined. Now, this situation is no different than what happens in private companies as well. As interest rates rise, acquisition financing gets more expensive and harder to come by, and blue sky values typically go down because buyers' return on investment requirements go up. In fact, one could argue the most important determiner of a dealership's blue sky is the interest rate environment in which it is sold. With inflation continuing to run at or near a 40-year high, and the Fed indicating it plans to continue to raise interest rates even if we enter a recession, the old adage, "Don't fight the Fed," has never been more true in investing. We believe blue sky values will not rise much from where they sit today if interest rates continue to rise, and we could even see a decline if the Fed takes rates too far. Now, I'd like to close out this webinar with what we see as the biggest challenge in today's buy-sell market, and that is determining blue sky value. Auto retail entered its third year of record profitability in 22. Few dealers predicted the longevity of today's historic earnings rate. The challenge many now face is how best to value a dealership, given most dealerships are on pace to replicate or exceed 21's record profits, meaning we're going to have 3 straight years of these very strong profits. Now, as a reminder, most companies, including dealerships, are valued based on expected future earnings, as we talked about in the stock market. Commonly, we find that buyers calculate an average of the last 3 years' profits as a proxy for expected future earnings. Buyers will then apply a blue sky multiple to that average to determine a blue sky purchase price. Well, at 2022's current run rate, the industry is on track to earn $3.5 million per dealership over the most recent 3-year period once 22 comes to a close. That's 150% higher than the pre-pandemic average. So the question is, can this level of higher profitability sustain, especially in a rising interest rate environment, especially given the news today? And herein lies the buy-sell market's conundrum. Is the last 3 years an indication of expected future profits? Now, from a seller's perspective, the last 3 years of elevated earnings may be more sustainable than originally thought. Experts predict the market for new vehicles will be undersupplied for many, many years due to continued challenges in the supply chain and multiple years of pent-up consumer demand. Others expect the OEMs will avoid oversupplying the market in the future and instead, keep the market at a lower level of a 30-day supply of vehicles. These dealers point to the OEM's record profitability in 21 as a result of higher inventory turn rates and lower incentive spending. Now, in contrast to the optimistic seller's perspective, some buyers are concerned the industry will in fact revert back to pre-pandemic earnings once chip availability rebounds and the supply chain improves. These buyers believe most OEMs will weaken their resolve and once again compete for market share by overproducing vehicles and incentivizing consumers. In so doing, the OEMs could recreate the industry's historically low new vehicle margins, reversing the tremendous appreciation experienced over the last 3 years. Some of these buyers are also skeptical about the sustainability of recent operational efficiencies at the dealership level, particularly given current wage inflation. Many expect to see expenses rise in the future as the industry shifts from simply taking orders back to actually selling vehicles and maintaining inventory. Now, this all being said, these same buyers are also keenly aware of their need to grow in order to achieve the scale required to successfully navigate potentially dramatic industry evolution in the future. Scale has become a key strategic imperative for most of the largest groups, and even the smaller dealer groups who are looking to gain scale given how much capital they have, and they want to deploy this capital to ensure they're in a good position when we do see changes. These buyers understand that the longer dealership earnings defy historical expectations, the harder it is for sellers to justify a sale price based on pre-pandemic numbers. Now, interestingly, this methodology of using the last 3 years of earnings as a benchmark for future profits is pretty consistent with the way the public dealer groups are currently trading in terms of their blue sky value. Today, the public's aggregate blue sky trades at a 5.3 multiple of their total average earnings over the last 3 years. Of course, this is in stark contrast to their multiple on current earnings, which is just 3.4 times, as I mentioned. So if you apply what is commonly referred to as a liquidity discount to this 5.3 multiple to private dealership multiples, you actually come out at almost exactly Kerrigan Advisors' average private multiple based on our published multiples in our Blue Sky report. So this really does, to some degree, validate the methodology of applying our multiples to the last 3 years of dealership earnings. Effectively, that's the way the market is valuing the public companies. My final comments today are regarding franchise buy-sell market share and specific multiples. As you can see, since 21, imports have grown their share of the buy-sell market, which is impressive relative to their franchise share of just 34%, while domestics have seen a decline in their share below their franchise market share. Kerrigan Advisors attributes the weakness in domestic buy-sell market share to waning buyer demand for certain domestic franchises due to concern regarding the future dealership business model. Many dealers are worried, for instance, that Ford will significantly curtail future dealership earnings with the rollout of its new electric vehicles. Now, when we look at what drives franchise value, we find it is primarily throughput and expected future earnings per franchise. OEMs who maintain a high level of sales per franchise usually command the highest blue sky multiples, with Toyota leading the pack in the non-luxury segment and Lexus in the luxury. Dealerships in this upper right-hand quadrant operate with a much more stable and profitable business model, one with high UIO counts leading to stronger fixed operations and typically more used vehicle trade-ins, which enhances dealers' lucrative used vehicle business. Now, while the throughput is the key to franchise value, there are exceptions to this rule. In the case of Porsche and JLR, these franchises make up for what they don't have in volume with their incredible new vehicle margins and strong consumer demand for their unique products. The other exception are those franchises that have seen their sales per franchise greatly improve over the last few years despite the pandemic. In the case of Hyundai, Kia, Nissan, and Audi, these franchises have the potential to move toward the upper right quadrant if they continue to grow sales at their current pace. Now, this is the key, without adding franchises. The remaining franchises in the bottom left quadrant have lower sales per franchise and thus lower multiples. The value of these dealerships typically lie in the operator or the location rather than the franchise. For example, a bottom left quadrant franchise located in a place like Austin, Texas, will command a much higher multiple, not because of the intrinsics of the franchise, but because of where the franchise is located. Now, as we look at this four-quadrant graph, it is quite clear that the imports currently have a much stronger business model than the domestics, at least for now. To finish up this webinar and continuing with the college football theme, while it is unclear whether blue sky values have peaked at this time, it is clear that dealers are having a lot more fun than they were before the pandemic. The rising tide of industry profits is lifting all boats and making auto retail a winning game again. Lou Holtz, the legendary coach from Notre Dame, said, "How you respond to the challenge in the second half will determine what you become after the game, whether you are a winner or a loser." I would say we are likely entering the second half of this tremendous period of record earnings. How you manage your dealerships as we come out of this period will have a big impact on your win-loss ratio, particularly as you navigate the changes coming to auto retail. I am confident most dealers will find their way to a win. Thank you very much, and I am happy now to answer any questions that anyone has, and you can type those into the Q&A box here. So I do have one question, which is, do you think electric vehicles will have a negative impact on blue sky values? I would say that at this juncture, it really is interesting. We really don't know. And I find it quite fascinating that when we are going to market, we rarely even are asked about the impact of electric vehicles in our pro formas or our clients' pro formas of the business. And that leads me to believe that while there's certainly lots of announcements being made by many OEMs, I think that the market as a whole is quite skeptical as to when we're actually going to see meaningful market share in electric vehicles. So at this point, we're not seeing an impact from all the announcements about the move to electrification. Okay, I have one more question here, and then certainly if anyone has any other questions, you're welcome to, I got another one here. You're welcome to reach out to me directly, and I'm happy to have a confidential conversation. The question is, what are your thoughts on Cadillac and Buick GMC given the number of buybacks by the OEM? You know, what I would say about those two is that I think the OEMs are very focused on the fact that throughput per franchise really does enhance the value of those franchises. And that's why I said at this juncture, imports are winning the game because they have higher throughput per franchise. But I do believe that General Motors is very focused on trying to get to that juncture where they do have higher sales per franchise, and they're doing it by buying out dealers. We had a transaction where we actually sold a Cadillac dealership in a transaction, and then at the closing, General Motors just bought the franchise and closed it down. And so that was pretty interesting to us. They paid a good value for it to the dealer. So I do think this could benefit the last standing dealers in that franchise network, as I expect the throughput would increase. The next question is, have you found another resource for industry operating data now that NADA took its financial profile offline? So that was a sad day at Kerrigan Advisors when they did do that. We have other resources and analytics that we are using and deploying as a firm to, at this point, estimate a lot of the earnings numbers. And we do think we're going to have a resource in the next 12 months or so to supplant the data that we did receive from NADA. So that is something that we're working on. Okay, well, thank you all very much for your time. Again, I'm happy to answer any questions you have in the future and have a confidential conversation. But in the meantime, it is about as clear as mud whether blue sky is peaking, although there are some headwinds that may result in a peak in the next 12 months. Thank you very much.
Erin, thanks so much for joining us again. We always look forward to the knowledge that you share and love having you on. Again, you will all be receiving a copy of this webinar by the end of this week. To those on the line, join me back here a week from today, Tuesday, September 20th at 2 p.m. Eastern, as Dell Technologies talks about the threat landscape, how to protect you and your customers' data in an evolving world. For more information about AIADA, visit aiada.org. Thanks for tuning in and have a great day, everyone.